There are two primary methods of analysis in trading or investing: fundamental analysis and technical analysis. Fundamental analysis involves analyzing a company's financial statements like income statement, balance sheet, and cash flow statements to determine the intrinsic value of the stock. If the stock price is below the intrinsic value, it is considered as a good investment opportunity, and vice versa. Technical analysis involves analysis of supply and demand in the market to determine where the price trend is headed. When the demand is greater than supply, price rises. If the supply is greater than demand, price falls. Any tool used in the technical analysis is used to identify this imbalance and use that to make profits. Tools used for technical analysis are chart patterns, indicators, oscillators, price action, Elliot waves, and sentiment analysis. These are either used independently or in combination to identify appropriate entry and exit points in the trade. Now let's look at the differences between fundamental analysis and technical analysis. The first difference is the tools used in the trade. On the technical side, the tools used are chart patterns, indicators, oscillators, price action, Elliot waves, and sentiment analysis. On the fundamental side, the tools used are news, income statement, balance sheet, and cash flow statements. The second difference is the trading time frame. Fundamental analysis takes a long-term approach to trading. The focus is more on buying and holding the stock for long-term investing. Technical analysis takes a shorter to medium-term approach to trading. The trading style is classified into scalping, where the trade is executed in few minutes, intraday trading, where the trade is executed in few hours, and swing trading, where the time frame of trading is few days. Technical traders use risk management to minimize their losses and improve their chances of winning over time. Let's get deeper into the tools for technical analysis, starting with price action. There are two key aspects to price action: trend, support, and resistance. Trend indicates the directionality of price. There are three types of trends: uptrend, downtrend, and sideways action. Uptrend price action is characterized by higher highs and higher lows. Downtrend price action consists of lower highs and lower lows. Sideways action, which is also called horizontal trend, is the case where price moves within a channel. It's widely agreed in technical analysis that trend is your friend until it isn't. Now let's talk about support and resistance levels. Support levels are price zones where the demand is perceived to be strong enough to prevent the price from falling further. Resistance levels are price zones where the selling is thought to be strong enough to prevent price from rising higher. Support and resistance levels are psychologically important levels where lots of buyers and sellers are willing to trade the stock. When the trend lines are broken, the market psychology shifts and new support and resistance are established. Generally, when the support gets broken, it acts like a resistance, and when the resistance is broken, it becomes a support. Chart patterns serve as a visual aid in gauging emotions of the traders and allow us to see big picture. The way they work is that there would be a prior trend followed by a chart pattern, and the kind of pattern that forms determines where price is headed. Chart patterns are classified into three types: a reversal pattern, a continuation pattern, and a neutral pattern. A reversal pattern signals that the prior trend will reverse upon completion of the pattern. A continuation pattern signals that the trend will continue once the pattern is complete. A neutral pattern indicates a bullish or a bearish move irrespective of the prior pattern. Prior trend does not matter in a neutral chart pattern. These patterns can be found across any time frame. Let's look at some popular chart patterns. Discussing about each individual pattern is beyond the scope of this video, but I'll leave a link in the description box for you to explore further. The key things to pay attention in any chart pattern are: first, prior trend. Check whether the pattern is likely to occur on an uptrend or a downtrend. The second, pattern structure. Shape of the price movement during pattern formation. The third, volume structure. See how the volume levels are during the prior period, during pattern formation, and also completion of the pattern. Fourth thing to look at is the price target, where the price is likely to reach after completion of the pattern. These patterns occur on any time frame, so being able to identify them and act on time requires patience and skill. Now let's look at indicators and oscillators. Indicators represent a statistical approach to technical analysis as opposed to subjective approach. All indicators are some form of a derivative of price action, so some traders see them as redundant and exclude them from their analysis. Indicators can be classified into many types depending on their properties. The popular classifications are the leading indicator and lagging indicator, oscillators and non-bounded, overlay and independent. Let's look at each type in detail. Leading indicators precede price movements and try to predict the future. These indicators are mostly helpful during periods of sideways action or non-trending price movements since they can help identify breakouts or breakdowns. RSI and stochastic oscillator are quite widely used leading indicators. Lagging indicator follows price movements and act as a confirmation tool. These indicators are mostly helpful during trending periods where they can be used to confirm that a trend is still in place or if it's weakening. Moving averages or Bollinger Bands are well-known lagging indicators. Let's look at second way of classification, which is oscillators and non-bounded. As the name suggests, oscillators have values bound by range. For example, RSI indicator may have a low of 0 and a high of 100, where 0 represents oversold conditions and 100 represents overbought conditions. The value of RSI indicator always stays within 0 and 100. Non-bounded indicators are not constrained with upper or lower limit. For example, MACD indicator can take any value and is not bounded by any upper or lower limits. Let's look at the third way of classification, which is overlay and independent. Overlay indicators, as the name suggests, are overlaid onto the price action. For example, moving averages and Bollinger Bands. Independent indicators are shown in a separate graph, example MACD and RSI. Now let's look at how indicators generate signals. Indicators generate buy and sell signals through crossover or divergence. Crossovers are the most popular way to generate signals where the price moves through a moving average or two moving averages crossover. Divergence occur when the direction of price trend and the direction of indicator are moving in opposite directions, which tends to suggest that the direction of price trend is weakening. There are two types of divergences, a bullish divergence and a bearish divergence. Sentiment analysis is a process of identifying perception of public towards a particular stock. Social media networks are a collective expression of human emotions.
There's all the things that we like and hate and fear. They're all there on the internet. They're a projection of our limbic system. It's true.
No, it makes sense.
Information from social media platforms like Twitter, Facebook, and Reddit are downloaded using APIs offered by the respective platforms and exposed to sentiment analysis tools to gauge how positive or how negative is the public sentiment towards a particular stock. If the sentiment is overwhelmingly positive, it is seen as a positive sign or a bullish sentiment. Contrarily, if the sentiment is negative, it is perceived as a bearish sentiment. Since trading is a zero-sum game, sentiment analysis is used as a contrarian indicator. So when the sentiment is extremely positive, traders see it as a sign to sell. Similarly, extremely negative sentiment is seen as an indication to buy. As Warren Buffett said, be fearful when others are greedy and greedy when others are fearful. Elliot Wave theory was developed by Ralph Nelson Elliott in the 1930s. The basis for Elliot Wave theory is that price action is a reflection of mood swings of traders from optimism to pessimism. According to this theory, price moves in the form of impulse waves and corrective waves. Impulse wave consists of 5 subwaves that make net movement in the same direction as the trend. Corrective wave consists of a combination of 3 subwaves that make a net movement in the direction opposite to the trend. Impulse and corrective waves are fractal in nature. It means each impulse wave can be subdivided into 5 subwaves, 3 of which are impulsive and 2 are corrective. Similarly, each corrective wave can be divided into 3 subwaves, 2 of which are impulsive and 1 corrective. These impulse and corrective waves can be further divided into same proportions. Conversely, these waves can be combined to form a higher degree impulse or corrective wave. This fractal nature of impulse and corrective waves is what allows traders to analyze market from multiple time frames. For more information on Elliot waves, follow the link in the description. That wraps up the video. I hope you found this informative. Please leave your thoughts and suggestions in the comment section. Talk to you in the next one.